to the Trust the Plan podcast. I'm Nick.
And I'm Jim.
Jim, I am really excited about this week's topic.
I know, I'm sure that you are.
I know that we've talked about Roth conversions before, and you probably are just turning the channel right now because you're like, oh no, here we go again. But now we have some really nice upgraded software which can show you, what it would look like if you don't do it versus if you do it. Okay?
All right.
So let's dive right in. We've got Sam and Sally Smith as our hypothetical client here. And basically, I want to show you if their base plan, their plan looks great. Okay, so cutting right to the chase here with no Roth conversions. These people are going to retire at age 65. And the portfolio, as you can see, just continues growing. They have a great benefit plan. They don't spend that much. And so they're able to continue saving and continue growing until death. So they would die with like 16 million, about 15 million at age 100. So they're in great shape. So we think, hey, what a great plan, right?
Absolutely. It really shows what you can do if you start early and you save consistently and you live within your means. They're a perfect example of that.
Yeah, and Jim, this is only showing 5% returns. So
yeah.
And they're aggressive, so we should be able, I think, to earn more than that.
Outpace that, sure.
Yeah. Okay, so now what if we do Roth conversions starting in retirement? So starting at age 65 and beyond, and we ask the software to tell us to convert as much as possible and still staying in that 12% bracket, the 12% bracket that exists today. Mm-hmm. Okay? So we toggle this button. Toggle this button. And now it's going to show at age 100, we'll actually have a lot more money. We're going to have over 18 million. So it's like a $3 million increase by doing Roth conversions.
Yeah.
How is that possible?
It's significant, isn't it?
Yeah.
When your money can grow tax-free and when you can optimize your tax bracket, it's a powerful thing.
It is. So let's think about all of these conversions that we're going to do. So as you can see, it starts in retirement age, like age 68, 65. The conversions don't start until then. So between now and retirement, the plans are identical, but the divergence begins then. And we're able to convert, $100,000 a year and stay in that 12% bracket. By the way, it says 15% because 15% is what the tax rates will revert back to if they don't do anything with the new rules. So we're expecting that 12% gets extended, and the proposal is that it would be permanent. So it would not be sunsetting like the first time around. Yeah. So these are with the higher tax rates, okay? So I think it can be even more opportunistic if the taxes change. So they're able to convert during all these years. They're even able to convert after the required minimum distributions start and still stay in that 12% bracket, which a lot of times people can't do.
Yeah, and this is one of the more powerful things about the strategy is, being able to get money out in that 12% bracket, in that good bracket. And the more that you can convert before your RMDs start, the less you'll have to take later down the road when
Exactly.
the RMDs do kick in.
All right, so here's our cumulative tax over our life. So these people would pay $2.8 million in taxes between now and death, which is actually $549,000 less than the base plan.
Yeah.
So they're converting earlier, paying taxes on the conversions, and yet somehow still paying less tax over their life.
Spending over $500,000 less in tax.
Yeah.
Yeah, it's remarkable.
And so remember, it was like 15 million in the base plan at age 100 versus like 18 million at age 100. So there's like 3 million of more money, and you also pay less tax over your life. Now here's the real kicker, okay? Because you might focus on that 3 million of new money, but that's not the whole story, Jim. Ready for this? All right. So Jim, it's about what is that portfolio made up of? And here we see the Roth is 7.3 million, okay, of the net worth. And when we toggle it back off, So now we're back to the base plan. The Roth was only 1.7.
That's amazing.
Yeah. Did I make a mistake?
No.
Okay.
No, that's awesome.
So more money, less taxes, and then when the beneficiary collects the money, it's like an extra 5 point some million in Roth.
Yeah, and I mean, and you got to recognize too that Roth money passes to the next generation tax free as well. They have 10 years for that money to most likely double again before they need to take those withdrawals. So it's incredibly powerful.
Yeah. Yeah. So 10 years, it's going to double again. So that 7 million probably would be 14 million tax free. Whereas if they continued on this current plan, it would be 11 million pre-tax, which you need to take a required minimum distribution each year. And then eventually all of it must be drained from the IRA, from the beneficiary IRA by the 10th year. So it's going to be taxed extremely heavy, right? So yeah, it's Sam and Sally, their kids are going to be the real winners. And some people say, well, my kids are going to be fine. I don't. But Sam and Sally are paying $500,000 less taxes as well.
Still paid less, I know.
So this is what we call a Nash equilibrium.
Yeah.
1 + 1 = 3. Everybody wins. Disinherit the IRS. Drop the mic. Roth conversions all the way.
Yeah.
Okay. So if you want to do a Roth conversion analysis and see how your situation compares to Sam and Sally, maybe it looks even better. Maybe not. But there's probably an opportunity in there somewhere.
Yep.
Yeah. Yep. So reach out to us at peakwm.com. We can do a second opinion for you.